Hello, everyone, and welcome back to Module 1, Strategy 101. And today we will continue this module with Lesson 3, Charts 101. And today is going to be an exciting lesson because today we're finally going to go into our beautiful price charts. And we're also going to do a little bit of a practical application and a little bit of interaction later on towards the end of this lesson. So these price charts that we're going to take a look at, they are made up of thousands and if not millions of data points. Well, that depends on the time frames and the historic backdrop that we're going to load into these charts. So we have access to a lot of data on a lot of markets, and most of this data is for free, and some data may even be paid for. And this is a relatively new phenomenon. When I started trading, for example, roughly 10 years ago, I still had to subscribe and pay to get real-time and accurate market data. Now, turn back time even 30 years further, virtually no one had access to the kind of data that you have access to today. So just keep in mind that this is a really powerful thing, and that's a relatively new phenomenon that, however, also comes with its own sets of challenges at times, but we will not go into the challenges for now. So most data today is free, and well, there may even be free data which is actually delayed by 15 minutes. So it's not real time, but it's still free. But irrespective of paid or unpaid, there's one thing that is really important here: the accuracy and reliability of the underlying data that we're looking at. And so the best available data, what I call institutional data, can be found only by looking at the real future symbols. Now, most brokers, if you have experience with other brokers, other than TradeStation, for example, they will give you their replica of the real versions, so-called derivative symbols or derivative charts. What they are is they're just replicas, basically. They're copy-paste symbols that just track the real charts. And we don't really want to look at the replicas to make the analysis. Why? Because, well, those can be quite deceiving, and oftentimes they're lacking history. So they're lacking historic and accurate data. The reason why real future symbols and charts give us the real underlying and accurate data is, well, simple. Futures are traded on a central exchange. So this would include the CME, the Chicago Mercantile Exchange, or the ICE, the Intercontinental Exchange. And if you are an institution, then you must access these markets through these central exchanges. That is one central marketplace. And that is the only way. So that's the place where institutions go to buy and to sell. And therefore, it just makes sense that when we're going to go and make the analysis whether we want to buy or we want to sell, then we should be looking and we should be going to the same marketplace where we see the same prices. Another important point about the futures markets is that only if we have access to the real futures market data, we have access to the Commitment of Traders Report 2. So remember, big money is regulated by the CFTC, and they are by law required to show their position sizes or their commitment in those markets once a week. And in fact, we will go into the COT and how the COT interplays with price charts already today. So I want you to remember two things here before we go into the price charts. Number one, we base our analysis on the same current prices and the same reliable historic prices that institutions have access to and where they go to buy and sell. And number two, looking through And looking at those central marketplaces, we can also track there, as in the institution's historic buying and selling activities. And we want to track that relative and in interplay with price. And the emphasis here is really relative to price, right? And in interplay with price. So we don't just want to track them, but we also want to see, hey, what is happening to price as a result of them doing buying or selling, right? And so in easy terminology, we could look at the following. What do institutions do, for example, when price rallies? What do they do when price declines? And on the other side of the spectrum, how does the retail trader, the novice trader, usually behave in the market? When are they really greedy, and when are they tremendously fearful? And where is price usually positioned at that point, and what happens to price thereafter? And the smartest way, or another smart way of looking at this, is kind of the other way around, because it is our understanding that what the institutions are doing affects price. So there must be an interplay between price and the commitment of these large traders. So if we know what the institutions are doing and when they're doing it, we can then predict the markets ahead of time. So for instance, let us say the commercials, the users and producers of commodities are heavily buying, and they're buying more than they have bought in the last 3 years, then we can predict a major rally in the marketplace. And now all of that we're going to cover today, right? This was just a little bit of an introduction of all the things that we're potentially going to take a look at. But we're also going to talk about charts. We're also going to talk about candlesticks and the flow of price, of course. And only towards the end of this lesson, I'm going to give you a glimpse on the COT report. And we're going to look at the COT report relative to price charts, specifically looking at the so-called commercials, the users and producers of the commodities that we trade. But if we have time, we'll also take a look at the retailer and potentially how the index also comes into the play here. But I really want to keep it rather surface level. I don't want to go too much into detail here, but I do want the end of this lesson, when it comes to the COT, to be potentially a little more interactive. So these beautiful price charts that we're going to be looking at day in and day out, what they represent is they just represent price movement through time. So if you take a look at this chart to your right, then this chart would represent the price movement of Apple price per share through time. And it would represent that in the form of candlesticks. A price chart usually has one horizontal axis and one vertical axis, and the horizontal axis shows time and the vertical axis shows price. So we move through time from left to right, with the further you look to the left, the more historic data you would be fetching. So left is the past and right is the present. How price moves through time is presented to us in form of individual vertical candles. And these vertical candles display where price traveled to in that specific time period. So in other words, candlesticks represent transactions that have taken place in the marketplace. They represent orders that have been filled. And the only way for price to move is if orders are being constantly filled. How many orders have been filled, or how many transactions have taken place in any specific candle, depends on many factors, I would say. But generally, the larger the time interval that each candle represents, the more filled orders or transactions that have taken place are shown in that one single candle. So these candles, we can choose them to be shown as different time intervals. You could go down to a 1 minute time interval, or you could go up to a monthly time interval, where each candle would represent the transactions that have taken place for that specific time frame that you selected. And that's something that we're for sure going to do in just a little bit in a short practical application. And so for now, just covering a little bit of theory, and then we'll put that into practice just in a little bit. So in this example, in the chart right now, you can see a 60-minute candlestick. And that means that each candle here represents transactions that have taken place during a time of 1 hour. So 1 hour, another hour goes by, another hour goes by, another hour goes by. So each candle here represents the trading and transactions that have taken place for exactly 1 hour, 60 minutes. The important point to understand is that charts and candlesticks, what they represent is they represent filled orders. Now, what do I mean when I say filled orders? Filled orders are transactions that have already taken place. So willing buyers and willing sellers that have already been matched. And the matching process of willing buyers and willing sellers, they then create candles in turn, and that's how price flows. But more about price flow a little bit later. The smart follow-up question here would be as follows. So if candles represent filled orders, then wouldn't it make sense to know who's the party or the participant that are filling, or at least trying to fill, their orders? In other words, who are the willing buyers and who are the willing sellers that create those candles? And thereby, what we're really asking is, at which price are potentially institutional willing buyers or willing sellers left that have not yet been matched? Okay, so these unmatched willing buyers and these unmatched willing sellers is what we call unfilled orders. So blind demand is going to be all about identifying unfilled orders by analyzing filled orders. Now, let me repeat. Supply and demand is all about identifying unfilled orders by analyzing filled orders. Now, the issue with unfilled orders is that they're technically invisible to us. We have no way of knowing where they are or where they could be. Well, at least so far. So I just want to park this topic on filled and unfilled orders and price flow for a second, and let's examine candlesticks a little bit more closely. So each candlestick displays 4 parts. So a high, a low, an opening, and a closing price of an asset for a specific time period. Remember, those candles, they're interchangeable. They could represent any time interval. So the time intervals or the time periods that you're calling for it or that you're fetching, they're called time frames, or they're called time intervals, or they're called time periods. These words are all interchangeable. And you could look at 60 minutes, you could look at dailies or monthly time frames, or in reality, anything that's in between. Now, the body of the candle that you see here in green and in red, they represent both the initial, the open, and the close of that specific time frame. Okay, so in the case of a green candle, the lower part of the body would be the opening price, and the upper part of the body would be the closing price. So it means that price traveled up or price rallied. For the red candle, it's just the opposite. It's vice versa. So it means that price opened right here and it closed down here. And if the close is below the open, the candle in turn turns red. And that means that price traveled down, moved down, price declined. Now you also have these little wicks on the top side and the bottom side. And these wicks, they show us the entire trading range during that specific time frame. So let's assume that these are 60-minute candles. So the wicks, they would show us where price traveled to outside of the open and close of the candles within that time period. Now those candlesticks, they may seem in the beginning very complex and it may seem very detailed, but they're actually very simple. And the more you look at them, the simpler they get. And what we use those candlesticks for is really important, is we use them to easily illustrate price movement and to also study price charts for any market around the world. And so if you, for example, go into the charts, and now you should see TradeStation, my TradeStation in front of you. And what you see right now is you see HGC on a 60-minute time interval, which means that I'm looking at gold. The price is live at the moment as we speak. Let's make this a bit bigger. And each candle that you're seeing now represents 60-minute of transactions, of order filling, that orders that have already filled, and willing buyers and willing sellers that have already matched. What you can also see is if you're going to zoom in here a little bit, you can see where this specific candle opened, and it opened right here at the price of 1885. You can also see where this candle is at the moment. You can see it's moving up and down, and you can also see that it's not yet closed, right? So we don't know where that's going to close yet, but what's happening at the moment, you have orders that are being filled. And what's important here is that it may seem like there's more willing sellers than willing buyers because the price is moving down at the moment. So there are a lot of orders that are being sold, a lot more orders that are being sold than are being bought, transactions that are happening, and this candle is not yet closed because the hour is not yet done. So if the hour would be done, this candle would just close, and then there would be a new candle forming right next to it, and that candle could be then either green or red, and you would have again those four parts. And so if we look at the candle before the one that's at the moment being created, because this one is already created, then we again have those four parts. We have the open, and we know it's the open because it's a red candle, right? And a red candle implies that the open is at the top and the close is at the bottom, and the close is at the bottom. It just means that price moved down within this specific time period of 60 minutes. So you have the close right here. And then in this case, you also have very large wicks, right? We have a large wick right here. And we have a large wick also right here. And what they represent is they represent the entire range, trading range of those 60 minutes. So if price had opened here, then maybe price went up first all the way to here. And then what happened is there must have been a lot of selling pressure that came in that pushed price lower, and it pushed price all the way to here. And then what happened in turn is there must have been some buying pressure that pushed price higher all the way to here, where then the candle eventually closed after the 60 minutes. So what we just said is that wicks, they kind of represent also selling pressure, and wicks usually, that's a bad color. So the top wicks, they represent selling pressure, and the bottom wicks, what they represent is they represent buying pressure. And selling pressure and buying pressure, because price goes up first and then price is beaten up. So it's a lot of selling pressure that comes into play. And then price goes down all the way to here, and then price moves up. So there's some buying pressure that comes in here too. So the wicks, they are buying and selling pressure, and the body of the candle is from open to close. And then you have either red or green candles that then tell you that price travel up or that price travel down. So there are some cases, where we see very large candles, right? Like here, for example. Oof, these are very large candles. And then there's other times where we see candles that are very small, right? So here, for example, so we have very small candles and we have very large candles. And so what would be interesting to see here is, well, who's on the side of these kinds of candles? Who's creating these candles? We know that this opened here, and we know that this closed here. We see that there's very small wicks. And so there's not a whole lot of opposite pressure here. There's not a lot of buying pressure that's coming in, right? And so there's a very large and big, massive candles. And what's interesting here for us to ask is, if there's willing sellers here, right? And let's say we have willing sellers. All of these are willing sellers, okay? And then we have willing buyers here as well at the same price. Then the question is, who was in control? Was it the willing buyers that were in control, or was it the willing sellers in control? Well, it must have been the willing sellers, and it must have been that there were a lot more willing sellers than willing buyers, because otherwise price didn't move down. Now, the follow-up question here is, well, if there were a lot of willing buyers and willing sellers, and there's a matching process going on, then is it possible that not all of those matched, right? Is it possible that only those matched with those? And therefore, is it possible that potentially we have a lot of willing sellers left at that specific price, because it all happened so fast? Price shot down and they were willing sellers at that specific price. So is it possible that they would still be willing sellers at that price? Well, that is very much possible. And in theory, if we have current price, the minute we're going to look above price, then we will find willing sellers, right? Because if price goes up, it becomes more expensive, there'll be willing sellers. Now, the higher price goes, naturally, the more willing sellers you will have, of course, right? The more expensive something gets, naturally, the more willing sellers you will find. It just has to be that way. And vice versa, if we are going to look below price, then the more we're going to look below price, the more willing buyers we'll find. Of course, because all of a sudden, the lower I go here, the cheaper price becomes. So that's really great, right? That's really great to know that, hey, the lower price goes, the more willing buyers, and the higher price goes, the more willing sellers. So that's a law of price. So as we said previously, we look at 60-minute candles. Now, those candles, they can be small, they can be really large. And we can also now change the candles, for example. So right now I'm looking at 60 minutes. I could now say, well, I want to look at 1-minute candles. And now we would get 60 candles that are made up into 61-minute candles that would be made up into one 60-minute candle, right? So we can now see, you can now follow right here, price is opened, and now price is moving. And if it moves up above the open, then it'll turn green. If it moves down below the open, it'll be red. And if it closes either below or above, it will stay red or green, depending on whether we close down or up. And now we're looking at a 1-minute time frame, right? And so remember, this was the 60-minute time frame. And then we could also take a look at a daily time frame. So these 3 days here, right? And I'm going back to the 60-minute time frame. This is 3 days of trading activity. So we can either look at it in a 60-minute chart, or we can choose to look at it on a daily chart. We could choose to look at it on a weekly chart. And now on a weekly chart, of course, because it was just 3 candles, now it's only 1, it's still being made up. And the highest time frame that we would usually use is the monthly time frame. And now you don't even see the weekly green candle that we just saw before. We just see one big red candle. Let us talk about maybe a more tangible example here to really drive home this concept of the flow of price. Because the flow of price, as we look at candles and as we look at intangible assets, if we look at just charts, then it's sometimes quite difficult to grasp. So let's make one tangible example that to drive home this concept. If you remember Corona, right, and you still were looking and following the markets back then there was a really interesting phenomenon that we could observe during Corona. Well, during the Corona crisis. Well, at first we know that market asset prices plunged, right? They really dropped. And afterwards, they quickly recovered and they went into all-time highs. So all kinds of asset prices, all kinds of stocks, real estate. And an interesting phenomenon that we could also observe during the Corona crisis is that the same thing happened with luxury watches. And the price for those luxury watches, they really skyrocketed. And it didn't matter if you were to look at Rolexes or APs or any other brand, all brands kind of behave the same way. But now let us just take Rolex for an example. And what you can see right here is their average price per watch in form of an index. So you can see here the price development for the past year in terms of the average Rolex price. And you can see that price back in April 2022 was at 38,000. And now it's at 28,000 per watch on average. It's roughly 10,000 US dollars lower over the past year. Now, during Corona, however, right, if you went to a store and you were looking to buy one of those, let's say, popular Rolex watches, let's say a Pepsi or a Batman, the cheaper ones, then you would be considered a willing buyer. You would be a willing buyer because you have the intent to buy, but you haven't bought yet. You don't have a Rolex on your wrist just yet. You just have the intent and you go to the store. Now, for those specific watches, it was not just you that went to the dealer, right? It was a lot of people that went to the dealer to get potentially the same watch that you wanted. So it means that there was a lot more demand than they had supply. In other words, there were a lot more willing buyers than willing sellers for these watches. And so if you go back 3 years and we look at the time where Corona hit, May 2020, March 2020, then you can really see this phenomenon. And why did it happen? Well, Economics 101, high demand and low supply equals rising prices. And at some point during Corona, there were even 2 to 3 year waiting lists, waiting periods for these specific types of Rolex watches. And the prices of these watches on average just skyrocketed, right? You can see this very well right here, all the way into the beginning of 2022. Now, if you put yourself in the shoes of a willing seller, then would you sell your watch for wholesale price or would you ask for more? Well, of course you would ask for more, right? And in fact, at some point, these watches, they sold on average almost double the wholesale price, right, on average. So you can see that they went from 20K on average per watch to almost 40K on average per watch. Now, I would call this 39K at the top an expensive retail price. So what you can see in any chart and what is going to happen in any asset is we're going to come across retail prices, expensive prices, and we're going to come across and see wholesale prices, cheap prices. Now, there are going to be 2 types of people. The one that just want this watch, this Rolex watch, regardless of price, and they're going to buy it even at very high retail prices, even at double the wholesale price. Why? Well, because they just want it, right? And they want it now. Now, that would be an emotional purchase. And generally, the higher you buy, the more emotionally involved you would generally be, right? So if you buy at the top here, and for sure, people would have to have bought at the top, at least some, otherwise there wouldn't be a price matching process and there would be no watch sold and therefore no watch bought and no watch sold at this price. And so therefore there couldn't be a price chart that would reflect transactions that had actually taken place, right? So there must have been some buyers that bought up here and there must have been some buyers that bought all the way here as well. And the higher you buy, of course, the more emotional that purchase would be. And then you have that other group of people that are going to wait for the opportunity to buy these watches or to buy this asset, whatever that asset is, or to buy that market for wholesale prices. Now, what's the downside of buying at wholesale? Well, if you want to buy at wholesale, at the dealer for the watch example, then you had this 2 to 3 year waiting time, right? This waiting period. So you have to be very patient to buy cheap. And the same applies to the financial market. Okay. All markets around the world go through rallies and declines. There's no market exempt from the laws of price and the normal flow of price. All right, so nothing goes to the moon without making at least a 50% retracement. Now, these retracement, yes, what we're seeing right now, these retracements here on the Rolex average watch index, they are very infrequent. Yes, they don't happen a lot of times, right? Price just rallied up for 2 years in a row. So they're very infrequent, they're very rare. But the beauty, hey, they do happen. And no market is exempt here, right? Not Tesla, not Bitcoin, or whatever market you're looking at. There's no exceptions. Nothing goes through the roof without making at least a 50% retracement. So what usually happens, right, when price had rallied or increased, what happens is there's a lot more supply than demand, because eventually the retail price is so high that there are just more willing sellers than willing buyers at that specific price. And so what has to happen, price has to decline. And again, you could easily see this beautifully illustrated from the Rolex example. And again, those are laws of price, and they are laws just like gravity. If you have more willing buyers than willing sellers, then price goes up. And if you have more willing sellers than willing buyers, then price goes down. First key takeaway here is that we would be the person that waits for wholesale prices to buy. And if price is selling at retail prices, then we would be a willing seller. The second key takeaway is that price flow is a mechanism of all willing buyers versus all willing sellers. They're in constant battle. And to illustrate that, we can look at this right here. We have willing buyers and we have willing sellers. For any market, for any price, there's always going to be willing buyers and willing sellers. If there's no willing buyer and if there's no willing seller, then there cannot be a matching process, and there's also not going to be a candle that's created. Right? The more transactions that are happening, the more volatile usually a market becomes. Now, let us say if you have exactly the same willing buyers and the same willing sellers, right? Like here, for example, they're matching up. They're exactly the same amount. Nothing happens to the candle, right? The candle cannot move if it's exactly the same while they're matching up. And now, all of a sudden, you have a lot of willing buyers left for that price, but you don't have a lot of willing sellers left. There's zero. The willing sellers have become zero. They've been canceled out by the sheer size of the willing buyers. And now what's going to have to happen if there's only willing buyers left is we are going to see and observe a green candle that is going to be formed. Now, to summarize here a little bit, what defines the trajectory of price? Well, it's the relationship between supply and demand that defines the direction of price. When I speak about supply and demand here, I speak about willing sellers and willing buyers. So if demand, or in other words, willing buyers exceeds supply, like we've seen with the Rolex example, then price goes up. It just has to. And vice versa, if supply or willing sellers exceeds demand, then price has to go down. The bigger the imbalance, the further we'll see price drop and the faster we'll see price drop. So the bigger the imbalance, between willing buyers and willing sellers, the faster and the bigger those candles will be. So we saw that there were really huge candles, right? And these huge candles, there are big imbalances between willing sellers and willing buyers. There's a lot of willing sellers. And all of these willing sellers, they canceled out the willing buyers. And because they canceled out the willing buyers, there were so many more willing sellers than willing buyers we can potentially assume that there are some willing sellers left. Now, the question is, how many of those willing sellers are left? How many are unfilled? And can we spot them? Can we find them? Right? And those are the questions that we need answered. Now, price changes direction when one force, so the buyers or the sellers, when one of them becomes zero at any specific price. So we just talked about this, right? So one of those forces were canceled out and they became zero. And for us, the question is, what is the origin and where is the origin of where that specific force became zero? In this case here, it's the willing buyers that were completely canceled out by the willing sellers. So where's the origin? That's the main question. And the science of trading supply and demand is to identify the origin of this change and the origin of imbalance. In the areas in the price chart where either the buyers or the sellers, they completely canceled out the other hand or the other party. Now, if we were to buy or sell at those imbalances, then we're potentially aligning ourselves with willing sellers and willing buyers that are potentially bigger than us. Okay, so if we buy at those imbalances, let's say demand, where the willing buyers canceled out the willing sellers, let me just go back to the slide, you don't see it. So if we buy at those imbalances, let's say we buy in demand where the willing buyers canceled out the willing sellers, then we would buy at wholesale, or we would buy into cheap prices, and vice versa. If we sell at those imbalances, or let's say if we sell in supply, so in supply imbalances, where the willing sellers canceled out the willing buyers, then we would sell at retail, or we sell into expensive prices. Now let us talk about the things that most people, and when I say most people, I would refer to the conventional, inexperienced, and uneducated trader. Let us talk about the things that most people use as a deciding factor of whether they want to be a willing buyer or a willing seller. And as you can see in the screen, there is so much information out there, right? And I'm not even capturing a small percentage of the information that's out there. And so we would have earnings reports, we would have income statements, central bank announcements, there are technical indicators, there are investment tips, there's broker recommendations, there's analyst opinions, and of course, there's so much news. And to me, it all boils down to a very simple question here if I look at all of this. And a question that I could put to you and that you could answer in your head is, do you really think that Goldman Sachs and other big banks and institutions take their trading decisions from those news that they then have access to at the same time as you? Probably not, right? I mean, as we understood earlier, they clearly have an advantage in the game, and their biggest advantage is their sheer buying and selling power. So if you're analyzing all of this, you better hope you're analyzing it the way that JP Morgan or Goldman Sachs is analyzing this. And so if you come to the understanding here of what I just said, then this is really powerful because it makes our lives so much more easy. If you come to understand the financial market, then you understand that the market is made up of mostly institutions. And what do? Well, they're just looking to sell high and they're looking to buy low, and they're trying to fill all their orders and all their positions. That's it. All those perceptions you may have, I tell you something, even all the perceptions that I may have, they don't really matter. They don't drive price. Institutions drive price. So what we need to do is we need to find a way to follow them. And so what we need is we need to find an objective and a mechanic way on when and where to buy and sell, and then also how to be good money managers. So in the last time, or in the last lesson, we talked about the set. And so if we have a set, then let's say we have an entry. We have a stop loss. And what we also have is we have a target, right? We have all those three parameters. And let me just put this here. We have an entry. We have a stop loss. And that stop loss, that's protective. It's the safety net. It allows us to achieve a calculated risk. And then we also have a target. And the target comes with a reward proposition, right? And the reward here may be plus 400 US dollars. And the risk also comes with a calculated risk proposition, and that risk proposition could be $100, a negative $100. So we can see that the distance from entry to stop loss is smaller than the distance from the entry to the reward. So we are maximizing our reward and we're limiting our risk, calculated risk. So our reward in this case is 4 times as large as our risk in terms of just the distance here. So in terms of risk to reward, just make a new text here. In terms of risk to reward, right? We have a reward proposition, we have a risk proposition. In terms of our risk to reward ratio, the objective measurable KPI that is really relevant to us, then here we have a 1 to 4, meaning that for every dollar we risk, we are to gain $4, right? So a 1 to 4, it could be $10, it could be $40 versus $10, it could be $4,000 versus minus $1,000, right? It could be whatever variable you put in as your risk. So whatever you're willing to risk, then you times that by 4, then you have your reward proposition up here. Now, that is what that is we're speaking about market timing here, right? We're placing a set and forget. And so what we need is we need market timing tools to place those entries, to place those stop losses, and to place those targets to get in and out of the markets very, very efficiently. And how we're going to do that is we're going to do that with supply and demand, which is a technical analysis. However, where's the problem here, right? So if we are really saying, well, this is price, and now it is triggering our entry. Now we're in this trade. Now we're filled, right? Now what we're doing is, well, we want price to come up there so that, again, we can exit the trade up here so that we enter here and we exit here. So we collect our reward, our profit. So what we're doing is, well, we're saying, well, price is going to go from A to B. Price is going to go from A to B. So what we're really saying is we're predicting a rally. But how can we predict that, right? How can we predict a rally? And so we need more than just the ability to place a good set. We also need to be predicting major rallies and declines. In other words, we need to predict in the bigger context A to B, whatever that is, right? And we need to be able to predict major rallies and declines. We need to say, well, price is going to go from A to B with a very high likelihood. And if it's going to go from A to B, then I just now need a way of timing this with supply and demand to make sure that I'm entering this with a high quality risk to reward proposition. Now, these are two completely different concepts, right? The right way of market timing has nothing to do with the right set of predicting major rallies with the right set of prediction tools, forecasting tools. So there are going to be setup tools. Right, so we will have setup tools, and these will be your forecasting tools. And then there are going to be timing tools as well, right? So we will have setup tools and we will have timing tools, and we use the timing tools to time the markets, to place a good set, and we'll use the setup tools to be able to predict the markets. Are we going to go from A to B? Now, why am I talking about all of this? Because we kind of covered all of this already, right? Well, I'm talking about this because if we're going to say, well, market is going to go from A to B, then very likely market's going to go from A to B, not in a straight line. Whoa, it would be nice if market would just go from A to B in a straight line, right? That would be amazing. So how market is going to go from A to B, more likely is that, let's say, price comes in, right? Now we're in the trade, now we're at A, now price moves out, and now price is here, right? And now, let's say we have one of those earnings reports or one of those investment tips that you read online, or you see something in the news happening, and there's something happening that may create intraday unexpected price movement, right? So in intraday, now something could happen to price due to any news event or due to earning reports or due to anything. We could have intraday volatility that is creating noise in the market. So this pink line now here that I did, this is noise in the market. And at times market can be random, absolutely so, right? We can predict the market every day, every step of the way, right? Sometimes market does something stupid and something unexpected. That's just how the market works. But if we apply a good fundamental analysis, then we should be confident that price is eventually going to go into the direction of B. And well, there could be another question mark. There could be another, oh, what is happening today? Oh, there may be FOMC meetings. There may be interest rate decisions. And something may happen on that day that creates additional unexpected volatility. But usually what is happening is that those news, they are just price accelerators, right? And eventually, if we apply good fundamental analysis, then we know where price is going to go. And we know that potentially price is going to go from A to B. But I also know, hey, along the way, there's going to be a heck of a travel, and there's going to be a lot of random days, and there's going to be a lot of things that I can't predict that are unexpected. And the slide that you just saw before that had all these things listed, all these question marks, they have nothing to do with trading. They have nothing to do with A to B, and they have nothing to do with the setup tools, and they have nothing to do with the timing tools. They're just question marks. They are noise. Most of the time, it's accelerators that usually just make, shakes off participants, and it shakes them off. And eventually price is going into the pre-planned direction. So this is very, very important, right? And later on, we'll talk about one of those setup tools, right? Which is the COT, those commercials, and how we can really predict major rallies and how we can predict price is going to go from A to B. We may not know when, but we know that, price is going to go from A to B. And then these timing tools, the supply and demand that we then use to get an understanding, where do we place all those parameters, because they are not random, right? And they have nothing to do with the setup tool. They have nothing to do with A to B. A to B is another set of analysis. So I know a market is I'm predicting a rally, but now I need to get into this market with a quality risk to reward proposition, maybe a 1 to 4. And then I use supply and demand, my technical tools, to get into those markets safely and efficiently. And what then happens along the way, man, that's market's going to be random. There's going to be noise, and not every day is going to be perfectly predictable. But the beautiful message here is that the longer, right, if I'm going to take here a time frame, and let's say I'm looking at a 1 month time frame, then within 1 month, I can be very good at predicting where market is going to go in terms of A to B, right? I can say that in that 1 month, what I'm assuming is going to happen is we're going to see a rally. But if you now tell me, if you're now going to ask, what is going to happen in that 1 day, right, of that 1 month, then I would probably have to say, well, we can take a look at it, but my first guess is I don't know, right? Because I have no fundamental tool that can tell me where market's going to go within that 1 day. Well, we will have some input on that later, but generally speaking, the market is much more difficult to predict on a lower time frame than on a higher time frame. So the higher you go, and then there's limitations of that, of course, as well, right? The higher you go, it's not always more predictable, because then also the higher you go, let's say over and above and beyond, like 3 months, 4 months, 5 months, a year, and then longer than a year, there's so many things that can happen, like outside events that are happening, like Corona, or like a war is happening. And so there's going to be a lot of things that obviously can happen in the long term, which then also don't become predictable. But let's say within the spectrum of 1 month or 2 months, and sometimes even a year, and within our yearly roadmaps, we also show that the yearly roadmap is possible. It's possible to predict, where market's going to go from A to B. We're able to predict major rallies, and we're able to predict major declines, right? And when they're going to happen 1 year in advance. And so it is possible, much more, and it is in fact not just possible, but easier to say prices going from A to B on a higher time frame, and on a lower time frame, on a 1 day, it's very difficult to say price is going to go from A to B. And if you now think about, well, what do most people do? Well, most people go and they look to predict the markets within 1 day and even shorter time frames. Well, it's just destined to fail, right? Why are people looking at those news and trying to predict those news if they're unpredictable, right? And what we should do is we should zoom out, focus on the things that we can predict best, which is longer terms, 1 month, A to B, and then use, our timing tool, supply and demand, to get into those markets with a quality risk to reward proposition. And the higher our outlook in terms of time frame, usually if you don't exceed that with many, many years, the more the easier it is to predict certain things, right? Because the markets, I will show you, are predictable in terms of major moves. Not always, but they're very reliably and consistently predictable. And however, the lower you go in terms of the time frame, the more difficult it will be to really predict the market, because there's a lot of random activity within those markets. And what we do, if we go, well, A to B, right? If we go A to B, then what we're doing is we're trying to take this randomness out of the market. All right, so let's move on, because I also want to do a little bit of a practical application later. So this is now a perfect transition into timeframes, right? We spoke about these longer timeframes; they're good to predict, and we spoke about those lower timeframes. Sometimes very, markets can be random, and so there are in fact 3 income goals that we'll be able to look at, or you'll be able to look at, and all those timeframes, all those different timeframes, they will be, and they have to be put into the right relation and into the right context to the kind of income goals that you're looking at. So there are 3 different income goals. There's a monthly, a weekly, and a daily income goal. And depending on the income type, the time frames in terms of the charts that you're going to look at, they're also going to change. So if we're looking at longer term trades, let's say monthly or weekly income, we're going to have to look at higher time frames. Now, I am personally focusing on medium term to longer term trades, and therefore I'm going to be focusing on weekly income and monthly income in line with higher time frames. And you see that when you follow my live sessions and my grid as well. Why? Well, simply put, because when you look at the longer term outlook, it's just easier to predict where the market's going to go. There's not so much noise in the market every single day. And yes, we just talked about this. The markets, they may be random. They may go up, they may go down 1 day to another day. But the longer term outlook, your longer term outlook, is kind of like taking out the randomness, the daily randomness in the market. So you're taking out the noise, and you're taking out all those news, and you're taking out all those news events. And if you take out all those news events, you will have your life as a trader will be a lot easier. Now you may ask, well, Jan, is there a perfect time frame? And the answer is, well, not really. What I can tell you though is that each time frame comes with its own unique sets of advantages and disadvantages, yin and yang. So higher time frames like monthly charts, they are, for example, really powerful to spot potentially major lows and highs in the market. And that makes sense because it takes more willing buyers and sellers to move monthly charts, right? And therefore, the supply and demand imbalances as a result that we can spot, they have to be much greater on those larger time frames. The lower the time frames, the more difficult it is to spot major institutions. However, the lower the time frame, the more accurate we can potentially be in terms of placing our set parameters. The smaller our levels from entry to stop, right? The smaller the distance from entry to stop, the more potential profit margin in terms of risk to reward we may have. So what we will eventually aim to do is look at multi-time frame analysis. So he would then use the monthly and the weeklies and the daily charts in perfect harmony. And we have to do that. We have to look at all of them because each chart will be giving us a different key input about the markets that we trade. So there's not really one perfect time frame. I could say there may be overall better ones than others, but we have to look at multiple time frames to analyze the markets based on supply and demand. Generally speaking, though, we can summarize a few things here to start off with. If we're looking at daily income, then we're going to be looking at trades that last for a few hours or a few days. If we look at weekly income, then we're going to look at trades that will last for a few weeks or maybe just a few days. And monthly income would be trades that last for a few months, maybe years, and maybe just a few weeks. But we're going to spend a lot of time on these different time frames. And I'm also going to give you a clear rule book here on what specific time frame to look for when you want to achieve a specific income goal and when you're undergoing a specific process of the analysis. So I'm going to be very, very specific and give you clear rules on that. So what's to remember? Well, the power of supply and demand, right? The technical analysis that's based on timing the market is going to be that it is universally applicable to all these income goals and to all the markets that we trade. The only difference is that things that you would cater for and you would apply is you would either use a higher or lower time frame depending on whether you want to trade for longer term trades or for shorter term trades, respectively. That's all. So now we can move into what I believe is the most interesting part of this lesson, and where I want, maybe if you guys are still here with me, to be a little interactive and answer some of the questions that I may have. So let's have some fun on this last part here, on these last couple of minutes. So in my view, one of the most important fundamental setup tools in the marketplace can be found when we look at the Commitment of Traders report, or in short, the COT report, right? This slide should be familiar to you. You saw that already in the last lesson, and I explained it a little bit, but not too much. Why is this report so important to us? Well, simply put, the COT report allows us to figure out what the big guys are doing in the marketplace. It allows us to follow them, and it will also allow us to get an understanding of the bias of the general public, these small traders and speculators, the ones that we call retailers, you and I, we would be small speculators, and therefore we would also be categorized as retailers here. And when they are, as a group, extremely greedy or fearful. And so the COT data that we're going to be following, it's provided by the Commodities Futures Trading Commission. In short, that's the CFTC. And that's just the agency that governs and regulates the futures and options trading in the US market. So what does the COT report contain? It contains historical records of futures contracts traded under the US market and US exchanges. And it is broken down by the position type. So it's either listed as a long position, a short position, and it's listed for 3 distinct group of traders. Now, I just want to talk about the commercials today, so you can see them right here, and they're under reportable positions. You have the commercials, we have a long and a short, and we're looking at gold, which is a futures commodity, and that's as per January 17th, 2023. So it's 1 or 2 weeks old. So we can see their longs and we can see their shorts right here. Now, before we continue, we spent, I think, already roughly an hour today together, and let's just park this here for a second. I am very cognizant of the fact that I may be overloading you with information, right? And the Bible tells us that there's a time to reap and there's a time to sow. And so at the moment, I'm giving you bits and pieces and I'm seeding, or in other words, I'm only touching on certain concepts that later we will build on, of course, right? So when I'm seeding, it may seem like I'm holding back information and that you may not have the full picture at hand all the time, or that you have gaps. And that's really okay. It's just meant to be this way, right? So we have to start seeding, and it's not yet time to reap, right? We will fill those gaps later on if you have gaps at that point. So back to where we were, we have those commercials, we have those longs and those shorts. And those commercials, right? Who are they? Well, let's talk a little bit about them, just very, very briefly. They're the users and producers of the commodities that we trade. So we would consider them to be the smartest money in the game for finite markets. And they're usually also the biggest participant in the game in terms of just the sheer contract sizes that they work with as a group. The commercials, the users and producers of the commodities, what they will do is they will sell higher prices and they will buy lower prices. So let me just maybe illustrate that by talking about a sugar example. So if you're a producer of sugar and you have a lot of sugar in your bins, I mean, a lot of sugar in your bins, and as per your cost outlook for the year, let's say your break-even point of selling your sugar is $15. So if sugar is trading at $15 as per your analysis, you're not losing and you're not gaining, right? You're at break-even. Now, let's say tomorrow sugar prices, they go up to $17. Now, what are you going to do? Well, it's very likely, since you have a lot of sugar in your bins, you're likely to sell some of your sugar, right? So if you're going to sell some, but maybe not all, but then price goes to, let's say, from $17 up to $19, what are you going to do? You're going to sell more. Then it goes to $20, goes even higher. You're even going to sell more. Then it's going to go to $23. And then you may sell all you have. Okay. And so this is the key characteristic of the commercials. They usually buy weakness, they buy into weakness, and they sell into strength, because they are not speculators, right? They are in this business to facilitate their business activities. This is then how they make money, right? As a group, they trade millions of dollars of real product, and then they facilitate the exchange through the futures market. And that is why they're the most important group for us to follow. We know that they're the biggest, they're the smartest people in the game, and I'll just maybe I'll be able to show you that. And their entire business model relies on their ability to buy and sell their particular commodity at the most advantageous prices, right? They want to sell high at retail and they want to buy low at wholesale. Therefore, it would also make sense that they have the best trading desks and they have the best analysts on staff. So for example, let's say you want to trade sugar, right? And in trading sugar and in understanding sugar and understanding whether you want to be a willing buyer or a willing seller, you would undergo a fundamental analysis of sugar. You would look at the physical supply and demand. You would look at the weather conditions. You would look at how much coffee there is in the bins and how much demand is there from potentially major coffee buyers. And you would do all this analysis, right? And then maybe you will look at fertilizers and, oh, I've heard so many stories and I've read so many news on things that sometimes make sense, but have no track record of predicting where price is going to go, right? Most news or most things will explain away why something has happened in the past. Well, we need to explain away why something is going to happen, right? We need to be able to predict the future. So rather than having someone or listening to someone that explains away the past, we can just look at what the activity of the commercials is, because they are analyzing what we just analyzed as a group, right? So we can do this quickly, and we can do this, for example, with gold. So what you can see right here is it's the COT report of gold for just the users and producers, which are the commercials. And if you guys do not have this report, then it's available here under the Campos indicators. Under the COT index V2, you now have Campos COT users and producers, Campos COT retail traders, and Campos COT fund managers here as well. And so if you subscribe to the indicators, you also have access to those, and you can just download them very easily. You click on them and you download them, right? You have a download instructions guide right here. So let's not waste our time with that, but just wanted to mention that these can be found right here. And in fact, these are actually pretty newly created. Just added them today, not today, but a week ago or so. Right, so what we can see right here is the COT report for the users and producers, and it's the net COT data. Okay, what's the net COT data? Well, if you're looking at all their longs, 122,814 contracts long versus all of their shorts, 298,727 contracts shorts, you're taking the longs and you're subtracting the shorts, then what's left is their net position in the market. So if I go back to here, and this is a weekly report, and then I go to here, right? So this is from the 20th of January, which is the last time we had this update. Then you would see minus a net of minus 175,913 contracts. So in other words, we could put this in here. One second. So we could put that in here, right? So they are long at this point here where we have the cross. They're long 122,000 contracts. They're short 298,000 contracts. So their net is 175,913, just like we see right here, right? So that's the calculation. That's the net calculation. And you can see that this is an outdated report, right? It's from 1 or 2 weeks ago. Well, what's happened within those 1 or 2 weeks? Well, we can see that, again, there's a new activity that happened from week to week, right? They change their trading activity from week to week. And then so that means that if I look at this in the past, and if I now collect all their historic reports and I put this into a beautiful chart, then we can see eventually all of their trading activity, everything they've done as a group 10 years ago and every week in between. And now this is where it becomes really interesting. So this is going to be a gold example. And I love the COT report for gold. And most markets around the world, they come with these so-called cams, right? The bull cams and the bear cams, but nowhere else in any, regardless of what futures markets you're looking at, nowhere else are they as present as they are in the precious metal market, especially in gold. And the bull camp, the ones that are arguing and calling for wildly higher and higher and higher asset prices, they've made a religion out of these markets. And to them, the world is about to end, and the sooner and the better. And I know this because I really do feel the way sometimes as well, the same way. But then I realize, hey, things will move on. And they will get better, and I'll take a look at the commercials and I'll see what they're doing, and that puts everything into perspective as well. So we talked about the net, what the net means, right? We talked about what this line chart means. This is not representing price here, right? This is representing their buying and their selling activity over time, right? This is representing their buying and selling activity over time. So what's going to be really interesting is to see the shift of their buying and the selling. What does it mean if they're shifting from buying to selling? Well, it means that they're moving millions of dollars of real money, and they're moving that, right, the real money in the real world, and they're facilitating that in the futures market. Now, the focus as we look at this will be to look at relative highs and relative lows taken into consideration time, okay? Relative to time, not relative to the net number, right? You may see a net number here. That net number is not important to us, right? It's really not as important to us. What is important to us is their shifts over time. So how we could we word that? We could word that the following way. Are the commercials buying? And in reality, the right terminology would be accumulating, right? They're accumulators and distributors, because they're not buying and selling, they're facilitating their business activities here. So they're accumulating product, or they're distributing product in the real world. So they're accumulators and distributors. So just So you know that's the right terminology, but to keep it simple, if the commercials are buying at multi-year highs, could it be that they as a group are bullish? And if the commercials are selling or distributing at multi-year extremes, meaning the lower they go, the more they would distribute, the more they would sell, could it be that they are bearish as a group? So to put this even into easier words so that now everyone will follow me, the higher that this chart goes, okay, and do I look at 10 years? Yes, the higher that this chart goes, it indicates that the more the commercials buy as a group. You may have just finished that sentence on your own, right? In your own head. And then remember, we want to buy when they're buying. And the lower this chart goes, it indicates that the more they're selling as a group. And as a result, the more bearish they are as a group. And remember, we want to sell when they're selling. Now, one last thing before I'm gonna ask for your input. We're gonna have those net positions here, right? They're net positions. And what we'll also find is we'll have a zero area right here. Just let me make this exact here. We have a zero price. Well, zero price. We have a zero net position. And just put this here. Everything that's above the zero line is what we call generally net long. And everything that's below the zero line is what we call net short. Okay. Those are just additional terminology. So it makes sense, right? If they have a negative net contract value on the table, then of course they're net short, right? They're net short right here, they're net short right here, they're net short right here, they're net short right here. If they're positive as a group, they would be considered net long. Okay, so all of this would be considered net long, all of this would be considered net short. Now, these are not so important terms most of the time. And you can really see this here as well, right? They are net short virtually all of the time, right? They are net short here, they're 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 net short all of the time because they're below the zero line, right? And what we know is that gold has mostly rallied in the last, I would say, 10 years. Well, in the last four or 5 years more so. And so if price has rallied in the last 4 or 5 years and yet they were net short, then whatever that value is here, it really has no meaning at all. What has meaning is, again, their relative shift over time, multi-year highs, multi-year lows. That is going to be important for us. So in other words, what is going to be important for us is the higher they go, the more they're buying, the more bullish they are. And the lower they go, the more bearish they are. So let's focus on good buy points, right? Let's say we're in the camp of gold bulls and we want to be buying gold. Now I want each one of you to tell me, based on the commercials buying activity in the past, what would have been for you good buy points fundamentally where you saw a good setup in terms of price is going to go now from A to B, price is going to go into rally mode. I'm predicting a rally, and I'm predicting a rally because the commercials are heavily buying, they're heavily accumulating. So point out a few areas where with high confidence, you could say, well, the commercials are really bullish. And therefore, from this point, I'm going to predict a rally. And so I'm going to put vertical lines into this, and we're going to see how that then interplays with the chart. And there's no right or wrong here, right? So really don't be shy. So Yara is asking if you have, so Yara is asking, so let me just go into this question. She's asking, do we have access to this indicator that I have right now? Yes, you do have access to this indicator as well. And you'll find that within the indicator folder, right, under Campus COT Index V2. Here I'm right now looking at the users and producers only, right? And so you may be looking at the COT index, which is something different than the net positions. While the index is derived from the net positions, we also want to understand the net position and how our index is what our index is derived from. Okay, so two different shoes. You have access to all of that. For now, stay with me. Okay, focus on my question, and if you cannot come up with an answer or an area here, then also let me know, right? So Zina, you're right there. Okay. So Zina just put an area here. So let me put this here. Zina, just one. Okay. The others need some areas as well. So you put 2. Okay. So these are some areas where you would say from these areas, from these date stamps now, right? Zina would be predicting rallies. So let me mark this green if I can. Wells is going to take a stab at this, right? So the beauty is we'll, for better or for worse, we're going to look at what price did after. So there's really no right or wrong. There's just learnings here. Okay. Alex is putting something here. Okay. And here. All right. Just 2 is fine, Alex. 2 is fine. Who else is going to take a shot at this? Come on, don't be shy. If you're watching the recording right now, you can take your time as well and look at what we take some decisions here too, right? So let me maybe, you're same as Alex Cervantes. Let me again rephrase something. So the higher the lines go here, the more the commercials are buying. Okay, the users and producers, the ones that have the best, they're the biggest player in the game. They're the smartest player in the game. So the higher they go, the more they're buying. Okay, so, and I'll give you a chance. I'll give you all a chance to redo that if you want after this, what I say. So the shift in what they do, right? The higher they go, the more they're buying, right? The more they're buying. And remember, we want to buy with them, right? Now, the lower the shift is in their activity, the more they're selling. Okay. And when they're selling, and we want to be selling. So the higher the line goes, the more bullish they are. Hence, the more bullish we should be. The lower that goes, the more bearish they are, and then the more bearish we should be. So really what we want to figure out, if we want to find the best buy points where we can say with absolute certainty that there was a good buy point, is what we want to find is the highest points relative, right? Their relative highest points of their trading activity. So now you guys, if you want, you can go again, right? You can go again. And I'm not saying Zina's right. She could be, but you guys now have another shot of potentially looking at some new areas. So Alex, you're choosing the same. Okay, choose another one. There's many more left that you could potentially take a look at, right? You're agreeing. So you want this one? All right, let's take a look at this one here. Why did you come to the conclusion that this one, Alex? High and a buying point, right? There's a relative shift here and they are relatively high, right? Good. All right. You want to pick one more, Alex? This one right here. Okay. All right. Who else wants to go? There's many more potential areas left that we could look at, right? So many more left. Oh, there's some that didn't. So far I just have Zina and Alex. There's many more people in the room. Cervantes, I see you now. I almost didn't see you. All right, here. Okay. You're right. This is pretty high, right? This is just as high as here. It's higher than even here. So this is pretty high. All right. Yara, wait a second, Yara. I'm coming over to you. So these purple are from you, Yara? Okay. Okay. Okay, so let us now say, let us see what is going to happen, right? As we overlay price now and as we see how the commercials, how they interplay with chart. What we're basically saying is now based on the points that you all identified, right? With high probability that thereafter we should see rallies. So from the September 30th of September onwards, we should see a rally in gold. From the 26th of April, we should see a rally in gold. Here in October 2018, we should see a rally in gold. Here we should see a rally in gold, and always after we should see a rally, right? Because with this, we're predicting rallies. We're not. So we should be seeing rallies after, not before. So let me now do one thing and add gold. So now we have gold. Now we have the gold chart, and you can see that the indicator is now pushed down a bit. And up here we have our candlestick chart on a weekly. So each candle now represents a week. And what you're seeing, what you should focus on is what happened after these. So let's start with the one that I believe Zina pointed out, which was this one and this one. So Zina pointed out these two. So what did I get here? We got a rally in price, right? Forget about what's happening in between. We got a rally in price. What's happening here is, we got a rally in price. Now let's take a look at the one that Alex pointed out, and I think Alex pointed out this one, and I believe this one, here we also got a rally. And here we also got a nice rally. Keep in mind, these are weekly candles. So each candle represents an entire trading week, right? So you're predicting rallies that last for weeks, weekly, monthly income. Now, who else was there? There was Cervantes. Cervantes pointed out this one. Cervantes, did you point out another one as well, or just this one? I think it was just this one. And Cervantes here as well predicted a rally before it happened. And then we had lastly, I think it was Yara. Yara in yellow now. She said here, here, and here. And now we're seeing a rally. Oh, we're seeing a rally. And we're seeing a rally. So all of you, in fact, based on not looking at price, right? We didn't even look at price. When we look at price, we do a technical analysis. We don't look at price and do a fundamental analysis. We didn't look at price. We looked at the commercials, and we looked at their relative buying and their relative selling activities over time. We didn't look at what do they do here or here or here. What we looked at is we looked at a relative shift in their buying activity. So we looked at multi-year highs and multi-year lows. So what's also quite interesting, we just looked at multi-year highs. What's also quite interesting that these highs that you picked, right? You pick this one, you pick this one, you pick this one, you pick this one, and then this one, and then this one, and then this one, and then this one. There may have been always different kind of net positions here, right? But what's more important is that here we're at a relative high compared to the previous years. Here we are at the high. This one is much higher, right? But here we are at the high relative to the prior years. Here we're at the high relative to maybe the last months. Here we're at the high relative to the last year. Here we're at the high maybe relative to the last month. Here we're at the high relative to the last month. So here we're at a high relative to the last month. So what we can also argue is, well, what are the biggest, by far the biggest buy points? Well, the biggest buy points was this one and this one. Well, it may have been this one, right? So this one and this one. And so the biggest two buy points that we see, and maybe we can include this one as well because it's a pretty large buy point as well, and then we could include this one as well, right? So these ones are, in fact, if you look at the extremes, the very extremes, the all-time high buying activity, right? They've never been higher than this. Right? This is the highest that they were in the last years in history. That is the second highest that they were in all of this time. Well, if we look from left to right, at this point, that's the highest that they were compared to these prior highs. So we get a large rally. Then they're even higher. Here we get even a higher rally. Now they're as high as they were here. And now again, we're getting a massive rally. So why is this a fundamental indicator? Because it puts price into context of whether price is cheap or at wholesale, and whether we want to buy, because we want to buy at wholesale and we want to follow those institutions. And now, if we can say that what Cervantes said here, that we're expecting a rally, right? Or what Zina said here, if we're expecting a rally, if we can predict that price is going to go from A to B, then what we need to do next is we need to have a way of timing the market with the quality risk to reward proposition before it completely takes out. And this is then where we're going to look at price and where we're going to place our set parameters on. So we can conclude that commercials, what they will do is they will make tops and they will make bottoms. They are responsible for major turning points in the market. And this is really the key takeaway here, right? Commercials are most important to us when they are at an extreme reading relative to historical buy and selling activities. The focus here is on relative, and it's all about the right context. And with that, we'll be able to predict major rallies and declines. And so if we were to put our index in now, then all these relative highs and all these, and there may be so many more, right? There may be a relative high here that created a rally. There may be a relative high here that created a rally. There may be a relative high here that created a rally. There may be one here that created a rally. All these relative highs that we then see will be shown within our index. And will be picked up by our index. So I just thought about whether I should now put the index in there or not, but I thought this would now be really an overload of information. But quickly, if you have 10 more minutes, right, let's now do the following, since we're talking about this already. We looked at the commercials. Now what we want to do is we want to look at the retailers as well. All right. And for argument's sake, I'm going to remove the drawings here. Here we go. And what we're going to do is we're going to look at the past 30 years. All right. Because look, we can also go into the very past. So with the retailers as well, right, we can also see what they're doing. How can we see what they're doing? Well, the individual small traders and investors, they don't really have to report their position size, right? But their position size is still in the system. And because the CFTC knows which ones are the reportables, they have some leftover positions, which are then, they know, okay, those are not reportables. Those are the non-reportables. They're not large enough positions and they're not institutional players. They're the little guys. And so they just take the leftovers and they put them in the report as non-reportable. So we know, hey, if they're not institutions, if they're not reportables, if they're non-reportables, then who are they? Well, they have to be the retailers because there's no other participant. There's only institutions and the retailers. And so those non-reportables here at the far end, they would then be what we have right here in this red net positioning report also throughout time. So now I want you guys to tell me, when was the time that they were the most bullish, the retailers, so the retail trader, the small trader as a group, when was the time that they were most bullish? And when was the time that they were most bearish? In other words, is the time that they had the most buying activity and they were the most bullish, right? Because they were buying as a group. They had a lot of net positions on, so they were buying as a group. And when was the time that they were really selling or fearful as a group? So the higher they go, again, the more they're buying, just like the commercials. The lower they go, the more they're selling, just like the commercials, right? And so we have one spot here. This is the highest the retailers were in the past, 10 years. Okay. What's the lowest? Someone else go. What is their lowest? So if this is the highest, then what is their lowest? Alex, yes, then this is their lowest. So let me just put this in red. So what is now interesting to see is the most bullish that the retailers were was the start of the only bear market that we ever saw in gold, right? It's the only bear market in history that we ever saw in gold. It happened from the commercials were selling, right? They were relatively selling, and all the retailers, they were like, yeah, now, now I gotta buy. This is when probably you'll hear your uncle or your work colleague telling you about gold. This is the time when you then look at this indicator and you're like, hey, they're all pretty bullish. It's probably not a good idea to be buying right now, especially not if the commercials are selling, right? And so what we can see from this point is, well, they were pretty wrong, right? As wrong as you could be, right? As well, if they at least were neutral here, it would be fine, but they were as a group, right? It's all of them put together in one basket. As a group, they were as bullish as they ever were. Now, Alex pointed out here is where they were as bearish as they ever were. And guess what? That's also right around the time when it was the low of the low of the low, which led to a multi-year bull market. And this is the time probably where you would hear, oh man, gold is going to go, it's who needs gold anymore? And you better sell your gold. And this is when you hear on the street that everyone is dumping their gold. So you can see by just looking at this, right? What you can see is that they are usually wrong. They usually do the wrong thing. Now, it's not just me saying that. These are hard facts. This is what you can see by looking at just these charts, right? And when they're selling, the commercials are buying, right? And when they are buying, the commercials are selling. And so when the retailer as a group are relatively bearish, again, it's all about relative in the right context, then markets are destined to rally. These people just can't be right too long, right? And when they are relatively bullish, markets are really destined to drop. So that's then, right? Again, these are hard facts. Last slide for today. These are the retailers. And how else do we know that they are wrong? Well, we really just saw it in front of our eyes, right? We really just saw it here. They were most bullish right before a 3-year bear market, the only bear market ever recorded in gold. Right before that, it was the most bullish that they've ever been. And then they were the most bearish right at the bottom of that bear market, where then we went into a bull market that lasted almost 8 years now, right? And so these are hard facts. What else are hard facts is that if you, for example, look at brokers like eToro, for example, and eToro is not the only one that is reporting this. It's Wanda, it's all other brokers as well. If you look at the fine print, then they're saying that 81% of retail investor accounts lose money when trading CFDs with this provider. So again, it's not all of them that are wrong, right? There's the 19% educated, experienced retail trader there as well, right? It is possible to do well. However, as a group, most of them do pretty badly, right? Most of them lose money. So those are the small speculators. When they're bearish, the market is usually rallies. When they're bullish, the market usually drops. Extreme buying leads to tops in the market, right? We just saw this, and extreme selling leads to bottoms in the market. So they are not wrong all the time, but they are wrong most of the time. So it's really interesting how here, for example, they say invest better together. Well, how so? If 80% of all together are losing, then how can you invest better together, right? Probably not. So very clever marketing from eToro and from other brokers, but rather what we should be doing, if we know that, right, because they're onto something here, they're saying invest better together. Yes, if we know that they're all wrong, then couldn't we use this information and take a look at all of them? And if we know that they're all wrong, then, or very likely wrong, couldn't we look at this and say, well, better together, not so much, but if we know that they're together or up here, then we for sure, if there's one thing we're going to do, is we're not going to follow them, right? We're going to do the opposite. And vice versa, if they're all selling, then we're going to be doing the opposite, and we're going to be buying with the commercials and against the retailers. Right. So as long as you understand all of this conceptually, right, as long as you're not completely lost, then you're on the right path. There's going to be a lot of missing pieces and a lot of puzzle pieces that we need to put into the right place still, right? So we're still pretty much talking about the concept of things. And now this was all about talking about the concept of A to B, right? A to B, and how the concept of predicting setup tools, A to B, how then if we can predict a major rally by looking at fundamentals, by not looking at price, right? We did not look at price at all. By just looking at fundamentals, we were able to predict major rallies. And now next time we're going to use price to put in our sets, to put in our set parameters, and we're going to start talking about how the concept of market timing, supply and demand works, after which then we have the foundation to go into the next module where we really go into the rule book of things. So right now, it's all concept. There's no rules yet, right? But all of these things that we're doing, we can put into a beautiful rule book to then be very objective and mechanic in the way how we're approaching the market, as long as you understand the concept. So I'm going to stop the recording here. Thanks for watching. And now it would be time for you to hang around and ask questions if you want.